housing, from tariffs on lumber to sticky high mortgage rates. It's been a tough time for the homebuilder stocks lately and sentiment. But that said, our next guest believes it's time to buy the group. John Lovallo, the UBS homebuilders analyst, joins us here at Post 9. Welcome, John.
Thanks, Sarah.
So Diana Olick, who covers this, was just reminding us how dour sentiment is right now on homebuilding stocks after Lennar's earnings, for instance. Nobody on fast money wanted to buy it, even though mortgage rates have come down. Why?
It's a good question, Sarah. Look, I would tell you that in my time covering the group, sentiment is about as bad as I've seen it from an investor standpoint. There's a lot of things out there to worry about, right? There's tariffs, there's immigration policy, there's DOGE layoffs, and there's sticky interest rates that remain elevated. Our view is that a lot of this is already reflected in the stocks, and our channel checks would suggest that the spring selling season is actually going okay. Now, there are some nuances with Lennar we can talk about, but overall, demand is still there, and getting product at the right price points out into the market is key, and that's what some of these builders are really trying to do.
Is the drop in mortgage rates bringing in buyers?
The drop in mortgage rates, interestingly, from a public home builder standpoint, they're buying down rates to 5 or 5.5% already, right? So what it allows them to do is take a little bit of margin. So they can kind of smooth out the fluctuations in rates with these buy down programs.
We saw pretty decent existing home numbers yesterday relative to expectations. Yeah. Inventories are up a little bit, definitely not to sort of long-term normal levels. How does that play into the case for the home builders themselves? They had this advantage from buying down mortgages and obviously lack of supply elsewhere.
Yeah, it's a good question, Mike. Look, we would take lower interest rates all day long, even if it brings some supply back to the market. The existing home market is dysfunctional. I mean, even with the above kind of consensus print, we're running at 4.3 million units. That's a million units below where it should be. And so to the extent that there's turnover, that's good for both the existing home market and the new home market.
And how are these stocks valued now? I was just looking at the overall group, and I don't know, maybe they're kind of middle of their 10-year range in terms of price to book. I'm sure there are exceptions, but how does it screen out at this point in terms of bad news being priced in?
That's a good question. I mean, we tend to look at them on a PE basis, and I'll tell you why. On a PE basis, they're trading at about 7 times earnings. We would say a normal run rate is between 11 and 12 through a cycle, and you can make an argument why they should be valued higher. On a price to book, to your point, it gets a little tricky looking historically because they own land differently. They also are buying back a lot of stock, so that kind of skews things versus history.
So on Lennar, what was the problem? Average selling prices were down 1%, still above 400,000. Is that what was a concern? Are prices strong?
The real investor concern was on the gross margin. Now, Lennar is in a situation where they spun off their land portfolio to Milrose, and they're taking down land on a very consistent basis by contract. They are incentivized to push volume. The other builders can kind of take a step back in markets where things are slower and say, hey, look, we're going to take a little bit more margin here and not push pace quite as hard.
So which one do you like best?
Our top pick in the group is Meritage Homes, which is kind of a small entry-level builder. Not small, but small relative to a Lennar or a D.R. Horton. D.R. Horton is another one that we've always liked.
We never talk about that one. All right, so thank you, John. John Lovallo from UBS.